Hi, welcome to my channel. I'm Gil Rossi, investor and funds manager. Today I want to share with you my analysis of Disney. I'm going to share the fair value and the IRR. As you may know, normally I do a qualitative and a quantitative analysis of a business. Today I'm going to share only this portion, but I have already done this qualitative analysis and I am happy with the business. Even though the financial position of the business is the weakest of all these four, let's say, especially I think due to the pandemic, they have increased their debt. And I think it's going to be just a temporary, let's say, situation. But I'm happy with the competitive advantages. I think that this business has very durable competitive advantages based mainly on the content and now the building of the distribution channel that they have started in 2019. So I think that the business complies with all my qualitative requirements, and we're going to focus only on this one today. Let me give you a quick view at the business. Walt Disney is a global entertainment company, as everybody knows. The company owns and leverages well-known brands like Mickey Mouse, Frozen, ESPN, ABC, National Geographic. All this provides high-quality content that, together with the great distribution execution, conforms the backbone of the competitive advantages that the company has. It has grown through acquisitions in the last 15 years at least, buying Pixar first in 2006, then they bought Marvel in 2010, Star Wars originator Lucasfilm in 2012. In 2017, they bought 75% of the interest in this video technology platform, which was the start of what's now direct-to-consumer distribution channel. In 2019, they bought 21st Century Fox, and with that came a controlling portion of Hulu. They have 24% of revenues coming from from outside North America, and 12% from Europe. They have been reporting these four segments up to 2020, and now they're going to change the reporting. So the four segments that they had was media networks, parks, experiences and products, studio entertainment, and direct-to-consumer international. Now they're going to keep this portion, parks, experiences, which includes parks, hotels, cruise lines, and the consumer products, in one segment, and then the other three are going to go into another segment, which is going to be called media and entertainment distribution, which will include linear networks, which were mainly these domestic cable and broadcasting, direct to consumer, which was ESPN, Disney Plus, Hulu, and Star, before direct-to-consumer and international, and content sales, licensing, and others, which is mainly studio entertainment before, which includes all the movies and all the musicals and the theater. So this, I think, is a better way and more aligned to the future, the new business, based mainly in the direct-to-consumer distribution channel, which is going to be the growth engine in the next few years. So if we go to the fourth quarter and final and fiscal year 2021 report, which happened in November 2021, we have the CEO, Bob Chapek, saying that this has been a very productive year for Walt Disney Company, as we've made strides in reopening our businesses while taking meaningful and innovative steps in direct-to-consumer and in the parks, particularly with our popular new Disney Genie and Magic Key offerings, which Bob Chapek says,
Walt Disney World rolled out its new multi-tiered full-service app, Disney Genie, which allows guests to easily and efficiently navigate everything our parks have to offer in order to have the best experience possible. The response to the service in just its first month has been extremely positive.
This is an app that will allow mainly to avoid lines and experience more of what the parks have to offer. And this magic key is a replacement, let's say, of the annual pass. Instead of having an annual pass, they are having a sort of like a subscription model. And then he's extremely pleased with the success of the streaming business, with 179 million total subscribers, 60% higher year over year for Disney Plus. This is a great number, as we will see in a minute a little more information about that. So in terms of revenues have been quarter to quarter, in a year-on-year basis, they have grown quite substantially, especially because some of the theaters and the parks have been open. But year over year, it's been flat. And the same story can be said for the operating cash flow and for the free cash flow. They have been growing quarter to quarter, in the last year, but on a yearly basis, they are substantially down. What happened is that they added 2.1 million subscribers for Disney Plus in the fourth quarter, and this is the lowest quarterly addition since inception. This missed street projections, and that led to the sell-off of Disney shares. But management reaffirmed its long-term subscriber guidance and noted that it had never promised that additions would grow in a linear fashion. So this is what Bob Chapek has to say.
I want to reiterate that we remain focused on managing our DTC business for the long term, not quarter to quarter, and we're confident we are on the right trajectory to achieve the guidance that we provided at last year's Investors Day, reaching between 230 and 260 million paid Disney Plus subscribers globally by the end of fiscal year 2024, and with Disney Plus achieving profitability that same year.
So what's important here to me is that in the long run, they are still aiming for this 230 to 260, and of course, quarter to quarter it can go up and down, but if you see the figures in a minute, they are really, really good if you see it on a longer period. I'm going to show you here from Credit Suisse a figure that shows how the Disney Plus has been launched in different markets, and so far they are up to here with roughly 60 markets that have been launched, and they have roughly 100 more markets to go in the next couple of years. So by the end of 2023, they will be in countries with 650 million total broadband subscriptions. And if we see in this graph, also prepared by Credit Suisse, Netflix and Amazon took 10 years to reach this level of broadband subscriptions, while Disney Plus is going to take roughly 6 years to reach that same level. So they are really ramping up the reach and the expansion very fast, much faster than all these three, which are HBO, Discovery, and Paramount, which are only reaching half the levels of these other three. In the 2020 Investor Day, they showed this slide where they show that the prior guidance for 2024 for Disney Plus, Hulu, and ESPN Plus was these numbers. But by December 2nd, 2020, they have already reached in number of subscriptions these levels. So they changed that, and they now have the following guidance for 2024. From 60 to 90 before in Disney Plus, now they have 230 to 260. It's amazing the difference here. Of course, one thing that I have to note is that this 60 and 90 didn't have Hotstar, and now this 230 to 260 has Hotstar, but this is roughly 30% of this. So in any case, it's a big growth from one investor day to the other. Hulu from 40 to 60 to 50 and 60, and ESPN Plus to 20 or 30 million. So all in all, if you add this together, is between 300 and 350 million subscribers by fiscal year 2024 is what Disney is expecting. So to me, this is in the long run the important story, that they are still aiming to 350 million subscribers, even though in this quarter they just added 2.1 million for Disney Plus. So let's now go and see the subscribers for October 2nd, 2021 for all the services, and they have 120 almost for Disney Plus from 73. This is the 60% that Chapek was mentioning at the beginning. And if you see, this is 44.4 million that have grown in the last year. We compare that with Netflix, which had 206 and now 225 roughly. The growth is 18 million. So they are growing much faster, even though they have a slowdown now of 2.1 million, as I said. If we check the total, which is 180 almost from 120, is 58 million of new subscribers. It's really growing fast at the 48% pace in the last year. If we go and check Netflix subscribers, and this is coming from Credit Suisse estimates, they have the 225 that I showed a minute ago. It has been growing quite steadily, and the revenues grow roughly in line with subscriptions. So now let me show you what would be the estimates of subscribers for the coming few years up to 2025, and this is coming from Credit Suisse. The estimation is that by 2022 the company Disney is going to have roughly the same number of subscribers that Netflix has now, and then this is going to grow. By 2025 it's going to have roughly 350 million. If you see, Netflix has a market capitalization of 250 billion, while Disney has a market capitalization of 280 billion. So the market capitalizations are similar, and by 2022 the two companies are going to be similar in terms of subscribers. So is either Netflix overvalued or Disney undervalued? We will try to see that by the end of this video. Okay, let me show you the income statement for the last 10 years. We see here the revenue has been growing quite nicely up to the moment that the pandemic hit, but it has been quite resilient because some businesses were hit very hard, like parks and theaters, but direct to consumer was benefited. So it was good that Disney had started the direct to consumer business a year earlier, and that had grown that fast, so that it was a really good timing, I think. If you see the blue dotted line here is the margins, operating margins, which were roughly 25% in the last few years, but came down quite a lot when they launched the direct-to-consumer business, and of course came even further down when they had to close the parks and theaters and all that. I think this is going to recover, of course, not to the levels of 25%, because part of this investment that they have to make is in content, and the investment in content is going to stay there. So let's have a listen to the CFO talking about this.
This will drive higher fiscal 2024 content expense on our P&L than we previously expected. We now expect our content expense to be between $8 and $9 billion in that year. This increase reflects several factors, including increasing investment in original content under the 5 core brands with which we launched Disney Plus, particularly Marvel and Star Wars, making a significant incremental investment in our production of original general entertainment content that will drive our Star and Star Plus offerings, producing and acquiring local content in international markets, which will increase our relevance and subscriber penetration in those markets. and the inclusion of Disney Plus Hotstar in our revised outlook, which includes both entertainment content and sports rights costs. We previously stated that we expected Disney Plus would reach its peak year of losses between fiscal 2020 and fiscal 2022. Consistent with this range, our expectation today is that Disney Plus will reach its peak year of losses in fiscal 2021. Given the value of growing our subscriber base, as you've seen today, we plan to reinvest revenue generated from our better-than-expected subscriber growth back into content investment. Thus, we continue to expect Disney Plus to achieve profitability in fiscal 2024. Again, I'll note that this guidance includes Disney Plus, Star, Star Plus, and Disney Plus Hotstar.
And now let's have a listen to Bob Chapek, the CEO, in the fourth quarter, talking about this investment as well.
We recognize that the single most effective way to grow our streaming platforms worldwide is with great content, and we are singularly focused on making new, high-quality entertainment. As you know, we announced at our last Investor Day that we expect our total content expense to be between $8 and $9 billion in fiscal 2024. And we will now be increasing that investment further, with the primary driver being more local and regional content.
To me, these large investments in content are not a negative thing. If anything, they are positive, because to me it provides strength to the competitive advantages and barriers to entry. And now going to the cash flow of course is affected by all these investments. In the fourth quarter and fiscal year, the reported $2 billion of drop in operating cash flow and $1.6 billion drop in free cash flow. And if we go to this graph showing the past 10 years of cash flow, we see that there was a dramatic drop here when they started to build this direct-to-consumer distribution business, and it hasn't recovered due to, we all know that the pandemic has been hitting Disney quite hard. Let me show you here some of the bases I'm going to use for projections. In revenues, if you see an article in Barron's that was based on FactSet, was showing the growth of each of these businesses up to 2025. And then Credit Suisse also had some forecasts that I'm also using, which are very similar to the ones that are shown here in Barron's. If you see, for example, the direct-to-consumer, which is growing quite fast, is going to be roughly between 35 and 40 for Credit Suisse, and here it's going to be 40 for the FactSet. If we see the parks, which is this orange, is going to be almost 40 billion in 2025, and the parks here is 33, so also quite similar. And they are assuming that by 2025 the revenue is going to be 110 approximately. So this is what I'm going to use for projections. And in terms of operating income, the FactSet information from that was shown in the article in Barron's for each of these businesses is what you have here, which I have put them in a table here, and on average they are going to be roughly 21% in 2025, while the Credit Suisse one is going to be by 2025 23%, but this one is adjusted. You see a little bit higher than the one from FactSet, but on the same range. So this is what I'm going to use as a basis as well to for the operating margin projections. So this is my income statement. This is the past income statement, and this is my projections. As you see, in revenue by 2025 I'm using 115 billion almost, And the operating margin, I'm starting with 10 and ramping it up to 21%. So the number that it's important here is this one, 49, almost 50 billion in EBITDA by 2031, which is the number I'm going to use for valuation purposes. And then if we see that in a graphical form, this is what's going to happen to the revenues, and this is what's going to happen to the EBITDA. So going from 16 to 49 or 50 is 9.9% per annum. And then if we go to the cash flow statement, this is the cash flow statement in the past 10 years, and this is my projections for the next 10 years. I'm reaching by 2024-2025 the same level that they had before the pandemic, or a little bit higher, and this is why I'm assuming a large increase here. But then I'm ramping that down to 11 from 12, and keeping the capital expenditures to revenues in 6%, which is almost the average that they have had in the past. So that gives me this free cash flow of 22 billion almost, and this is the one I'm going to use for valuation purposes. So when I calculate the 10-year target price, this is the numbers I'm going to use, free cash flow and the EBITDA. These are the ratios, and that gives me an enterprise value with, if I subtract the debt, net debt I think they will have in 2031, gives me the market cap, and with the weighted average stocks outstanding, gives me the price that I am assuming for 2031 for each of these two metrics. I mean, using each of these two metrics as the basis. Then I average these two and gives me the target price I'm going to assume for my calculations. Now let me show you this 15 as the ratio, why I'm using 15. And if you see, in the past the enterprise value to EBITDA has been 12, 10, 10, 11, 16, and well, this you shouldn't pay attention because this has been disrupted by the pandemic. So I'm going to use 15 as a little bit higher than the average pre-pandemic. But if you see in terms of sales, the average for the last 10 years was 3.7, and using 15 gives me an enterprise value to sales of 3 average. So I think that 15 is reasonable. Even in terms of enterprise value to sales, it's a little bit more conservative. And then this ratio 21, if we were to have a projection of the next 10 years of free cash flow from 31 to 41, using the cash flow growth at the start 2031, and then bringing that down to 5, and then from here onwards in perpetuity to 3, with a weighted average cost of capital of 10, then this would be the valuation of a company starting with 100 as a free cash flow. The enterprise value would be 2,140, which is why I'm using 21 here. So essentially what I am assuming is that the company will grow free cash flow at this level after 2031. So okay, this is the average target price. So with that target price of 286, and if I buy the stock at today's price, and I have the free cash flow per share adjusted that I'm going to receive during these 10 years, this will be the cash flow of the investor, which will provide this IRR and fair value. So if I buy at 155, it's going to be roughly 10% my IRR. So to me, this would be a good investment. If I go lower, of course, if I can buy at 124, it would be a great investment, 12%. I wouldn't buy over 155 because my returns are coming lower than what I would prefer. So I think that this can be, to me, the fair value of Disney today. And if you remember what we saw for Netflix and Disney a few slides ago, if this to me is fairly valued, then that means that this, I think, is a little bit overvalued. I haven't made yet the Netflix analysis. Probably I will make that in the future, and I will share with you, and we'll see whether Netflix is in fact overvalued or not. So that's all for now. I hope you find this video useful. If you do, please give it a like. If you haven't subscribed to the channel, please do so. And as you see, I like this company. The price is fair, and I think it's a good quality company to buy at a fair price. Of course, if it goes down a little bit, I would be even more interested. As you can see, I think that the 2.1 million, the extra subscribers for Disney Plus, which was a disappointment for Wall Street, to me it's not really a problem. The growth has been much higher than what they expected in 2019 when they launched, and for that, apparently they didn't have any improvements in the price when the investors saw that. But when they see just a tiny bit of let's say stumble in the growth of subscribers, then the price of the stock goes down, and that is an opportunity, I think, to invest in a company of this quality. And it happens many times that there are opportunities created by this short-term orientation of many investors. And Disney, it didn't drop that dramatically, but it still is presenting a good opportunity, I think. I thought that I would share that with you. I hope that you like it, and thanks very much for watching, and I hope to see you soon for another valuation video, probably in the next week or so. Thanks very much. Bye bye.